Imagine entering an industry dominated for decades by two giants, and within just a few years, you become the fastest network in the country. But here's the real question: does speed alone guarantee long term success? Good day, stakeholders. We are Kongkong Consultancy, and today we will be presenting our internal analysis of D2CME Holdings Corporation. D2 Telecommunity was originally established in 1998 as Mislatel. However, it only became relevant in 2019 when it was rebranded and granted a franchise to operate as the third major telecommunications provider in the Philippines. The company is backed by a strategic partnership between Udena Corporation and China Telecommunications Corporation, which provided both capital and technical expertise. As of today, D2 has reached over 15 million subscribers and continues to roll out its 5G infrastructure nationwide. This rapid growth highlights D2's aggressive entry strategy and its ambition to disrupt the long-standing duopoly. D2's vision is to become the industry leader in connecting and empowering Filipino communities, aiming to create a future-ready nation through reliable and high-speed connectivity. Its mission is to enrich Filipino lives through excellent services and digital innovation while reinventing the telecommunications industry using the next generation technology. In support of this, D2 has three key goals. First, to connect every Filipino to the people, places, and things that matter most. Second, to help individuals identify their community or telecommunity and feel more connected. Third, to make data access no longer a privilege but a right for everyone. From an analytical perspective, these statements are strong in purpose and relevant to the current digital gap in the Philippines. However, the limitation is that they remain broad and lack measurable targets, such as specific coverage goals or performance benchmarks. As a result, while D2's direction is clear and socially impactful, it still needs more defined metrics to guide its long-term strategy. D2 is led by Chairman Dennis Uy and CEO Ernesto Alberto, supported by executives specializing in technology, operations, and marketing. What makes their leadership significant is the combination of local business influence and global telecommunications expertise. This leadership structure enables D2 to execute large-scale operations efficiently, especially in highly technical and capital-intensive industry.
To better understand how D2 creates and delivers value, we analyze its business model canvas, which focuses on how the company operates, earns, and sustains itself. First, in terms of key partners, D2 relies heavily on strategic alliances. Its most critical partner is China Telecommunications Corporation, which provides not only capital but also advanced 5G technical expertise and engineering support. This partnership is crucial because it allows D2 to deploy a high-performance network much faster than a typical new entrant. In addition, D2 collaborates with tower companies such as PhilTower and EdgePoint. Instead of building all infrastructure on its own, D2 uses a shared infrastructure model, which reduces capital expenditures and accelerates rollout. This asset-light strategy is essential in a capital-intensive industry. Moving to key activities, D2's primary focus is on rapid network deployment and expansion to meet government coverage targets. At the same time, it invests heavily in marketing and subscriber acquisition through aggressive campaigns like Kaya Dito. Beyond telecom services, D2 is also diversifying into digital platforms such as Loon Academy for education and Unalytics for data analytics. This shows that company is not positioning itself as just a telecom provider, but as a broader digital solutions ecosystem. For the value proposition, D2 differentiates itself through its true 5G standalone architecture. Unlike competitors that rely on legacy systems, D2's network is built from the ground up, allowing faster speeds, lower latency, and better performance for data-heavy activities like gaming and streaming. Additionally, D2 targets price-sensitive consumers through affordable data sachet pricing. making high-speed internet more accessible to a larger proportion of the population. In terms of customer segments, Dito focuses on digital natives such as Gen Z users, underserved households without fiber access, and enterprise clients. This multi segment approach allows the company to expand both in consumer and business markets. For customer relationships, Dito adopts a digital first approach through its super app, where users can manage services, earn rewards, and engage with the brand. This app centric strategy enhances customer engagement and retention through convenience and gamification. Looking at revenue streams, the company primarily earns from mobile data voice and SMS services, as well as fixed wireless broadband. It is also expanding into enterprise solutions and digital services, which provides additional income sources. However, the cost structure reveals a major challenge. Dito faces extremely high capital expenditures for network expansion, significant operational costs, and heavy debt servicing due to its reliance on the borrowed funds. But overall, Dito's model is strong in value creation, but highly dependent on continuous funding.
From a macro perspective, Dito benefits from strong political support as it was introduced to increase competition in the telecom industry. Economically, the company faces high capital requirements and relies heavily on debt financing, while operating in a moderately growing but saturated market. Socially, there is strong demand for faster and more affordable internet, which aligns with Dito's offerings. Technologically, Dito has a clear advantage in speed and 5G performance, although its coverage is still limited compared to competitors. Legally, barriers such as high costs and slow processes affect expansion speed. Environmentally, telecom expansion raises concerns regarding energy consumption and land use. Overall, Dito operates in a favorable demand environment but faces structural and regulatory challenges. Dito competes primarily with Globe Telecom and PLDT, which dominate the industry. Globe focuses on building a digital ecosystem, leveraging platforms like Gcash to create customer loyalty. PLDT, on the other hand, focuses on infrastructure leadership, emphasizing network reliability and coverage. Dito positions itself differently by focusing on speed, affordability, and next-gen technology. In essence, Globe wins through ecosystem integration, PLDT through infrastructure dominance, and Dito through technological disruption. To analyze Dito's competitive environment, we use Porter's 5 forces, which shows how strong the pressures are within the industry. First, the threat of new entrants is low because the telecommunications industry requires extremely high capital investment for infrastructure, such as towers, spectrum, and data centers. In addition, strict government regulations make it difficult for new players to enter the market. Dito itself was only able to enter with strong government backing. Second, supplier power is moderate. Dito depends on a limited number of global telecom equipment providers like Huawei and Nokia. This means suppliers can influence pricing, especially during inflation. However, because Dito makes large-scale purchases, it can still negotiate favorable contracts. Third, customer power is high. Consumers have many alternatives, including Glow and PLDT, and switching between networks is relatively easy due to prepaid SIM usage. Because of this, customers are very price sensitive and demand fast, affordable services. Fourth, competitive rivalry is high. The market is already saturated and dominated by established players with strong brand loyalty and wider coverage. This leads to frequent price wars, aggressive promos, and intense competition for market share. Lastly, the threat of substitute is moderate to high. While Dito offers strong mobile data services, it lacks full fiber infrastructure in many areas. This allows competitors and alternative technologies to act as substitutes, especially in locations where Dito coverage is limited. Overall, these forces show that Dito operates in a highly competitive and challenging industry, where sustaining growth requires strong differentiation and continuous investment.
The Philippine telecom industry is dominated by the big three: PLDT, Globe, and Dito, with Dito currently holding a smaller but growing market share. The industry is projected to grow from approximately $12.1 billion in 2025 to $18.5 billion by 2034. 5G adoption expected to increase significantly, driven by lower device costs and higher demand for data. However, new technologies such as satellite to cell connectivity may disrupt traditional infrastructure models. For DITO, key success factors includes its 5G standalone architecture, strong spectrum capacity, strategic partnerships, and focus on fixed wireless access. These factors give DITO a strong technological edge in the market.
Now I will be presenting to you the financial analysis of Dito Corporation from 2019 to 2024. First, let's take a look at the overview of the balance sheet and income statement. In the balance sheet, as you can see, liabilities are greater than assets over time, which indicates how debt-reliant Dito became in its developmental stage, while costs and expenses exceed net sales in the income statement. Thus, we'll expect negative numbers in the following discussions. Before proceeding, it is important to note that revenue is not present in 2019 and 2020 as the company was still in its pre-operational and infrastructure development stage. Now, let's move on to the horizontal analysis. Starting off with revenue, we can see a strong, rapid, and consistent growth, which shows successful market expansion and increasing customer base. However, costs and expenses are also rising due to the company heavily investing in infrastructure, network expansion, and customer acquisition. For net income, the company continues to incur losses which have widened over time due to high financing costs and expansion-related expenses. Total assets have grown rapidly, driven by investments in telecommunications infrastructures. At the same time, total liabilities have significantly increased due to a debt-financed expansion strategy. Stockholders' equity is fluctuating, mainly affected by continuous losses despite the occasional funding increases. Meanwhile, operating cash flow is improving. Investing cash flow shows consistent outflows due to capital expenditures, while financing cash flow reflects reliance on external funding. Next, we move on to the vertical analysis. On the balance sheet, property and equipment made up the largest share of assets from 2021 to 2024, reflecting heavy investment in infrastructure. In 2019 and 2020, receivables dominated. For liabilities and equity, capital stock was largest in 2019 and 2020, showing reliance on equity funding. From 2021 onwards, trade payables, loan payables, and interest-bearing loans grew, highlighting increased debt financing over expansion. In the income statement, revenue was absent in 2019 and 2020. From 2021 to 2024, costs and expenses represented the largest share of revenue, sometimes exceeding it due to high operational and infrastructure costs. Now we move on to the financial ratios, starting off with liquidity. Dito shows a very low current, quick, and cash ratios from 2021 to 2024. This indicates that the company cannot sufficiently cover its short-term obligations. However, in 2019 and 2020, the ratios appear extremely high. This is mainly because the company had minimal liabilities but high initial funding, resulting in inflated ratios due to a small denominator. Overall, Dito's liquidity position is weak. Now looking at solvency ratios, the company's debt ratio and liability ratio exceeds 1, which means that liabilities is greater than assets. This indicates that the company is technically insolvent. Additionally, the debt-to-equity ratio is negative, which is due to negative equity caused by continuous losses. The interest coverage ratio is also low, showing difficulty in covering interest expenses. Overall, Dito is highly leveraged and financially risky. Next, we move on to the profitability ratios. All ratios are negative, including net profit margin and return on assets. This shows that the company is not profitable and continues to incur losses. Although return on equity appears high and positive, this is misleading because it is caused by negative equity, not strong performance. Overall, Dito is unprofitable as of now.
Activity ratios show how efficiently assets are used. Since Dito has large investments in infrastructure, asset utilization is still low, meaning returns from these assets are not yet fully realized. Cash flow ratios show the company's ability to generate internal cash. Dito's operating cash flow is improving, but still not enough to sustain operations independently. This explains its continued dependence on financing. investment performance remains weak with low or negative returns. This reflects high risk for investors due to ongoing losses and financial pressure. Dito's value chain shows how it creates value through its operations. Primary activities focus on network deployment, marketing, and service delivery, which are critical in acquiring and retaining subscribers. Support activities include technology development, partnerships, and infrastructure investment. The key insight here is that Dito's value creation is heavily concentrated on technology and network performance. However, this also makes the company highly dependent on continuous investment. Dito's current strategy is primarily focused on financing its rapid expansion. It uses leverage financing, shareholder advances, and equity funding to sustain operations. It also engages in refinancing and restructuring to manage its obligations. This shows that Dito's strategy is growth-driven, not highly dependent on external funding. The activity map highlights how Dito aligns its operations to support its competitive strategy. All activities are centered around delivering fast and affordable 5G services, including network rollout, pricing strategy, and digital engagement. This alignment strengthens its positioning as a technology-driven disruptor. However, the effectiveness of this model depends on execution and coverage expansion. Using the VRIO framework, we assess Dito's internal resources. Dito's spectrum assets and 5G standalone technology are valuable, rare, and difficult to imitate, giving it a potential sustained competitive advantage. However, other resources such as brand and distribution are not yet as strong as competitors. This means that while Dito has strong technical capabilities, it still lacks overall competitive strength in the market.
To evaluate Dito's internal position, we analyze its strengths, weaknesses, opportunities, and threats. For strengths, Dito's key advantage is its greenfield all-IP network, which enables superior 5G performance without legacy limitations. It has also achieved rapid market penetration, reaching over 15 million users, supported by strong partnerships like China Telecom, and validated by performance awards. For weaknesses, Dito faces high debt levels and continuous net losses, showing financial pressure despite growth. Its coverage is still concentrated in urban areas and its stock remains volatile, reflecting investor uncertainty. For opportunities, Dito can benefit from regulatory support like the Konektado Pinoy Act, expand its 5G fixed wireless services in underserved areas, and grow its enterprise and digital platforms. However, threats include intense competition from Globe and PLDT, emerging technologies like satellite connectivity, and geopolitical and regulatory risk. In summary, Dito has strong technological advantages, but its financial risks and competitive pressures remain key challenges to long-term sustainability. To summarize, Dito demonstrates strong operational growth, but this comes with significant financial risk. There is a clear gap between its ambitious vision and its current capabilities. While it leads in speed and technology, it still lags in coverage and long-term sustainability. Ultimately, Dito is a high-potential disruptor, but one that remains financially fragile.
So the question is no longer whether Dito can compete. The real question is, can it sustain its growth and survival in the long run? Once again, we are Kangkong Consultancy, reporting for Dito.